Hello and welcome to this next session of Economics for Finance. Hope you guys are doing well. In the previous sessions, we were discussing Chapter 1, Unit 1, that is National Income Accounting. Today, we are going to continue further with that unit. But before that, let's take a quick recap of what we have learned so far. We started the discussion by understanding what is national income, and we learned that the concepts of national income are important to gauge the performance of a nation, just like we have parameters to understand to measure the performance of a business. The same way, to understand and measure the performance of an economy, national income is one of the parameters. Then after we understood some more significance of national income accounting, and then after we came to a very important part of this unit, that was concepts of national income. The national income concepts were majorly classified into four: GDP, GNP, NDP, and NNP. However, as we learned further, we learned that these four can also be expressed in terms of market price as well as factor cost. So all in all, we learned eight concepts related to national income. Now, very quickly, I'll give you a highlight of the meanings. GDP, if you remember, was the money value of all final economic goods and services produced within the domestic territory of the country during an accounting year, which is gross of depreciation. Okay, inclusive of depreciation. Gross domestic product itself means that the production that we are trying to measure is inclusive of depreciation. Okay. Also, it covers the production which is undertaken within the domestic territory. Domestic territory does not necessarily mean political boundaries. We have already discussed that. But for now, I am just helping you remember that when we are talking about GDP, GDP includes all that which is produced within the domestic territory of the nation, regardless of who produced it. Right? It doesn't matter who undertook that production activity. As long as the production activity was undertaken within the domestic territory, it is a part of our domestic production. Okay, that was GDP, guys. Then we went for NDP, net domestic product. The only difference between GDP and NDP, as we discussed, was depreciation. So you deduct depreciation from GDP. That will help you obtain NDP. Then after we came to GNP, gross national product. And here we understood a very important difference, that was the difference between domestic and national. On one side, the concept of domestic is there, which tries to measure the production within the domestic territory of the country, regardless of who produced it. So here, when we are talking about domestic, where matters, who doesn't matter. The exact opposite of that is seen in the case of national. When we are talking about national product, it tries to measure the production by all the residents of the country during an accounting year, regardless of where it is produced. Right? So when we are talking about national product, what matters is who and not where. When we are talking about domestic product, what matters is where and not who. So this is a basic distinction that we have understood. While understanding the same difference, we also understood something known as NFIA, net factor income from abroad, where we discussed the example of Ramlal and Shamlal and Lisa, remember? So there I helped you understand what is NFIA. NFIA, net factor income from abroad, is nothing but the factor income earned by the Indian residents from abroad minus the factor incomes earned by the foreign residents from India. Correct? So that is NFIA. In order to obtain a national product from a domestic product, we need to add NFIA and vice versa. Okay. Moving further, we came to the last topic, that was NNP, net national product. Now net national product is nothing but GNP minus depreciation. These four concepts we discussed. And we also understood that all of them can be expressed at market price and factor cost both. So what was the difference between market price and factor cost, guys? Market price is inclusive of indirect taxes. So in order to find out factor cost, we need to first deduct indirect taxes and then we'll be able to obtain factor cost from market price. Also, because of subsidies, there arises a difference. So, when the government gives subsidy on particular products, then it reduces its market price as compared to the factor cost, and therefore we have to add the subsidies to the market price to obtain factor cost. Okay, so market price minus indirect tax plus subsidy will give us what? Factor cost. Similarly, factor cost plus indirect tax minus subsidy will give us what? The market price. Okay, and from here we understood the three fundamental differences. One, the difference between this market price and factor cost. The other, difference between gross and net. And the third, difference between domestic and national. And these three fundamental differences were very important to understand the entire national income concept. Okay. We also understood and discussed some short topics here which are connected to national income study, which were per capita income, personal income, and personal disposable income. Per capita income, as you remember, is per person income. We are not going to go into any detail for that right now. Personal income was a good topic, and here we had discussed the difference between incomes received but not earned and income earned but not received. If the incomes are received but not earned, they are a part of personal income and not national income. So they have to be added to national income to obtain personal income. Similarly, the incomes which are earned but not received, they are already included in national income, but they should not be a part of personal income, and therefore to obtain personal income from national income, they should be deducted. Right? This was personal income. And lastly, we had discussed personal disposable income. Personal disposable income is nothing but personal income minus personal income tax. Okay, so these are all the topics that we have covered so far, guys. I hope you would have viewed these lectures very thoroughly and you would have revised the topics. Now we are going to go further to today's topic, that is measurement of national income. Let's see what it's about. So, measurement of national income, that is the topic that we are starting with today. It's a very important topic for you, especially because we are expecting numerical questions from this topic. Okay, we are also going to practice some numerical questions at the end of the unit, so don't worry. I'll be taking up a few questions on my own, decided on my own, other than the ones which are given in your study materials. Okay. Now, what exactly do we mean by measurement of national income? See, we have already understood the concepts. Like, we know what is GDP, we know what is NDP, we know what is NNP, GNP, we know all the concepts, we know the meaning of them, and we know how to calculate one concept from another. We know how they are interlinked, right? We can do that based on those three fundamental differences. So we know everything about the concepts. Now the question is, how do you calculate even one of them? How do you find out GDP? Right? If you can obtain GDP, okay, fine, we can build upon GDP and we can, try and reach to NNP. But how do you find out GDP? How do you obtain the value of any of the concepts that we have learned in national income? Right? For that, we need to learn measurement of national income. Now, as discussed earlier, national income can be viewed from three different dimensions. There are three different angles from which you can view national income. What are those three different angles? One was production, the other one was income, the other one was expenditure. Now, why these three dimensions can give us the idea about national income? Because it's a circular flow. See, this is how it works. Whenever goods and services are produced, the production of goods and services, it results into income for people. Try and understand here, goods and services are definitely produced with the help of factors of production. Goods and services cannot be produced from thin air, right? There's no shakalaka boom boom pencil which can produce goods and services. So goods and services require factors of production, and factors of production, when used in the process of production, they will be earning some income. So whatever is produced as goods and services, it will be distributed among the factors of production as their incomes, which is rent, wages, interest, profit. Now, once the factors earn income, what are they going to do with it? What would you do if you have income? You would want to spend it. Correct. So, as soon as the factors of production earn income, they are going to spend it. Now, they can either spend it on consumption or they can save it for future. Correct? Assuming that taxes have been paid out, they can either spend it on consumption or they can save. In economics, savings is also a form of expenditure. Savings is called investment expenditure. See, whatever is saved, it's ultimately invested somewhere. So savings is known as investment expenditure, right? So in economics, we say that whatever is earned is spent either as consumption or as investment, and therefore the distribution of uh, production which was received by the factors as rent, wages, interest and profit, it is going to be spent either on consumption or investment expenditure, right? And when people spend, it's again going to result into production. So as you can see, it's a circular flow. It's a cycle, right? Production leads to income, income leads to expenditure, expenditure further leads to production, and it goes on and on and on. So national income can be viewed from any of the three dimensions. You can measure national income from the production angle, or you can measure it from the income angle, or you can measure it from the disposition, that is expenditure angle, right? And hence there are three different methods which are designed to understand each one of these dimensions. To understand how national income is calculated from the production side, we use the product method, also known as value added method, very commonly. Similarly, to understand the national income from the income side, we use income method, and from the disposition side, the calculation of national income is understood with the help of expenditure method. Okay, and now we are going to be discussing each of these three methods one after the other. See, production, income and disposition, these are the three phases of national income. In the production phase, this is just an outline, okay, of all the three methods. In the production phase, we are going to be measuring the national income by summing up the net value added. We'll understand what is net value added, how to obtain it, okay? Though we have already discussed in brief about value added, but how to calculate it, that will be covered here. We'll be calculating the net value added for primary sector, the secondary sector and the tertiary sector. That is for production side, okay? From income angle, we want to measure the national income, then we are going to sum up, we are going to add the incomes earned by the factors in the form of rent, wages, interest and profit, right? And from the expenditure side, if we want to measure the national income, then we are going to sum up the expenditures incurred by government, business units and household sector. See, these are the three units which are existing in an economy, right? Either there are households or there are government or there is business, right? These are the three units which actually spend in the economy. Household spends to satisfy their needs, businesses usually spend to invest, and government spends both for consumption as well as for investment. It also spends for administration and defense. Okay, so there are different reasons because of which they spend, but these are the three spending units, I can say, in the economy, right? The production phase shows the flow of goods and services produced, whereas the income phase shows the flow of incomes earned from the flow of goods and services, and the expenditure phase shows the expenditure on goods and services. And based on these differences, three different methods arise: the value added method, the income method, and the expenditure method. Okay, so now let's start with value added method. Okay, so what is value added method? What do you mean by value added? First of all, we need to understand that. See, value addition means whatever a producer tries to put in from his end to increase the worth of goods, that is known as value addition. So if I obtain material worth rupees 100 from somebody, I use my labor, I use my capital, and I try to increase the worth of those goods to up to 250 rupees. Then the 150 rupees addition which I have made to its worth, it was worth 100 rupees when I bought it. But because of my efforts, because of the labor that I have used, because of the capital that I invested, because of my managerial and entrepreneurial abilities, I was able to increase its worth to 250 rupees. The additional 150 rupees worth that I have created, I have added, is known as value addition. Okay, see. So under this method, national income is calculated by summing up the net value added. Okay, mark the words net value added. This is super important for us. Net value added by all the producing enterprises in the domestic territory of the country in an accounting year. Producing enterprises, domestic territory, and accounting year. These are also important. We'll be seeing their importance in a while. Okay. Now, this value added method is also referred to as net output method, production method, or industrial origin method. You have to remember the names because it might be the case where you are asked about a method using a different name. They might not use value added method. They will say industrial origin method, and you guys are all lost. What is industrial origin method? Okay, so don't do that. You'll have to remember the names. Okay, so net output method, production method, or industrial origin method. Right? Now, how does the value added method work? What is the operation? See, I'm going to help you understand the entire flow, okay? So pay attention. First of all, the entire economy is divided in three parts. Okay? The three sectors. Which are the three sectors? Primary sector, secondary sector, and tertiary sector. Correct? The entire economy is divided into three sectors: primary, secondary, and tertiary. I think everybody knows about these sectors. Primary sector includes agriculture and all allied activities. Secondary sector is basically industrial sector, and tertiary sector is the service sector. Right? Now, each of these subsectors is further divided into subsectors. So what are subsectors? Subsectors are a part of the main sectors. So primary, secondary, and tertiary, these are the three main sectors. Each of these sectors is further divided into subsectors. Sir, can you give an example? Of course. Listen. For example, the primary sector can be further divided into different subsectors. Subsectors like agriculture, fisheries, poultry, cattle rearing, animal husbandry. Right? So these are different, subsectors that we can find in primary sector. Similarly, there can be subsectors in secondary sector as well. Like the secondary sector subsectors can be For example, consumer goods industries, capital goods industries, small scale industries, cottage industries, large scale industries, medium scale industries. These can be the subsectors of secondary sector. The tertiary sector can also have its subsectors like transportation, communication, banking, insurance, education, healthcare. These are all the subsectors in tertiary sector. Getting the point? So understand the flow, okay? First of all, the economy is divided into three sectors. Each of the sector is further divided into subsectors. Okay. Now each subsector is further divided into commodity groups, or in case of tertiary sector, service groups. Okay, each of the subsectors is divided into commodity groups or service groups. Right? Sir, what are commodity groups or service groups? Okay, now I'll have to write in order to help you understand that. See, we are going to just prepare a simple flow chart on our own here. Let's say economy divided into primary sector, secondary sector and tertiary sector. Okay, as I told you, each sector has several subsectors. Okay, multiple subsectors. Right? We can take the example of any one in order to understand the entire concept, entire flow. Let's pick any one. Let's say I take secondary sector. From that, we take an example of consumer goods subsector. There can be several subsectors in secondary sector, correct? Let's take an example of consumer goods subsector. Okay, consumer goods subsector can be divided into different commodity groups. Like, now consumer goods can be of different kinds, right? So there can be, for example, clothes, there can be pharmaceuticals, there can be cosmetics, then your favorite, there can be electronics, there can be food and beverages, right? So there are different commodity groups. You understand the meaning of commodity groups now? Commodity groups are nothing but the collection of several firms operating into a similar kind of business. It's also known as industry, right? We say automobile industry, cosmetic industry, pharmaceutical industry. That industry is nothing but commodity group. Okay. Now, each commodity group has several producing enterprises. Okay, pay attention. Huh? Each commodity group is going to have several producing enterprises. So again, taking just one example out of several, let's say in clothes, there will be several different business firms which will be operating, correct? In the commodity groups of clothes, there will be several different industries operational, right? Now, out of them, let's take an example of one firm that, any one firm that will operate in India. Let's say Raymond. Okay. Now, my job is to calculate gross value added for Raymond. Okay. This is our task. What are we going to do? We are going to calculate the gross value added for Raymond. So what is gross value added? Okay, gross value added is nothing but value of output of Raymond minus the value of its intermediate consumption. We know the meaning of value added, correct? Okay, so value of output minus value of intermediate consumption. That will give me what? That will give me gross value added. Okay, sir, what if we want to calculate net value added? What if we are trying to find out net value added? Net value added is simple, GVA minus depreciation. We know the difference between gross and net, right? So GVA minus depreciation, that will give me net value added. Now I know gross value added, I know net value added. What I'm going to do with it? See, this we have calculated just for Raymond, but in the clothes segment, in the clothes wala commodity group, there are so many other producing enterprises which will be operational, right? There are different ready-made garment producing firms here in India. Okay, so what I need to do is I need to calculate NVA for each one of them. I'm going to calculate NVA for each of the producing enterprises operating in India. Okay, when I add the NVA of all those producing enterprises in the clothes segment, I will get the net value added of clothes commodity group. Similarly, I will have to find out NVA for pharmaceuticals, NVA for cosmetics, NVA for electronics, NVA for food, and all other different commodity groups which are operating in that particular subsector. Right? When I add the NVA of all these commodity groups in one subsector, I will get the NVA of that particular subsector. Pay attention, okay? Don't get lost. When I add up the NVA of all the commodity groups in one subsector, what I get is the NVA of that particular subsector. Okay. Then after, I will have to find out the NVA for each such subsector by following a similar process. I'll find out the NVA of each such subsector which is working under one sector. Right? So, consumer goods industries, capital goods industries, small scale industries, cottage industries, medium scale industries, right? All the industries which are operating under all the subsectors which are operating under a particular sector, I'll have to find out the NVA for each one of them. Then I will add the NVA of all these subsectors to obtain the NVA of the sector. Right? NVA of the sector. In the similar fashion, I will find out the NVA for primary sector and tertiary sector as well. Sorry. Okay, so I will find out the value added for NVA for primary sector, secondary sector, tertiary sector, all three, and combined of these three sectors. When I have the net value added of all these three sectors combined, I will have the net value added of the economy. The net value added of the economy, NVA of the economy, is nothing but NDP at market price. Okay, before I help you understand why do I say it's NDP, let me first give you a quick revision of whatever I just said so far so that it's clearer in your head. Let us, dissect the flow properly. Start with economy. We'll go from top to bottom and then again bottom to top. Okay, understand the flow properly. Economy divided into sectors, sectors divided into subsectors, subsectors divided into commodity groups. Each commodity group has several producing enterprises. Our job is to find out NVA of each producing enterprise in that particular commodity group. So for a producing enterprise, how do I find out NVA? NVA is nothing but the value of output minus intermediate consumption minus depreciation. Okay, value of output minus intermediate consumption minus depreciation. So now what do I get here? I find out the NVA of a particular producing enterprise. I add up the NVA of all producing enterprise to find out the NVA of commodity group. Okay, I add up the NVA of all such commodity groups in one subsector to find out the NVA of that subsector. I add up the NVA of all subsectors to find out the NVA of a particular sector. I add up the NVA of all three sectors to find out the NVA of the economy. And the NVA of the economy which is so obtained is the NDP at market price. Okay, now you must be wondering, sir, why is this NDP and why is it at market price? Okay, I'll help you understand. See, it's at market price because we have calculated this from value of output. Value of output is measured at market price. Okay, so we obtained this data from value of output which was measured at market price. So whatever we have obtained here is at market price. Correct? Sir, how is this NDP? How is this net? It's net because we have already deducted depreciation for each producing enterprise. Okay, we have already deducted depreciation for each producing enterprise. Therefore, it's net. Okay, sir, why is this domestic product? Because we have taken the value of the production, value added by each producing enterprise in the domestic territory of the country. Each producing enterprise, regardless of whether they are residents or non-residents. Okay. So what you obtained here is your NDP market price. Now from NDP market price, how do we obtain NNPFC? That is an easy task. Okay. First, let's see this flow one more time before we go to the further discussion. See, economy divided in three parts. Which three parts? Primary sector, secondary sector and tertiary sector. Each sector further divided into subsectors. Each subsector further divided into commodity groups or service groups. Each commodity group or service group has producing enterprises. Our job is to calculate NVA for each producing enterprise by using the following formula. What's the formula? NVA is equals to value of output minus intermediate consumption minus depreciation. Okay, and this will give us NVA of producing enterprise, and then we go in the reverse manner to obtain NVA of the entire economy, which is nothing but NDP at market price. Okay. Now value of output can also be measured as sales plus change in stock. Sir, what is this now? Oh, what is this new formula that you introduced? It's not a formula, it's simple logic. See, if I tell you that I did not have any opening stock of finished goods, I did not have any closing stock of finished goods, and I tell you that I have sold goods worth rupees 10,000. How much would I have produced? No opening stock, no closing stock. Sales 10,000. How much do you think I produced? Obviously 10,000. So sales is equals to production if there is no stock. Okay. Now assume that other than the 10,000 rupees worth sales that I have made, I also have 1,000 worth closing stock of finished goods with me. Now how much did I produce? 10,000 I sold. 1,000 is still lying with me. That means I would have produced a total of 11,000. Correct? But if I say that in the beginning of the year, I had, let us say, an opening stock of finished goods worth rupees 500. Now what would you say? What is my current production? Now 10,000 I sold plus 1,000 is lying with me. So I would say I had 11,000. But out of this 11,000, 500 was already available to me at the beginning. So how much did I produce in the current year? 10,500. What you did here is nothing but applying this formula. Sales plus closing stock minus opening stock plus closing minus opening is nothing but change in stock. Okay, clear? So just in case in any question, numerical question, if you find that instead of providing you with the number of value of output, they have given you sales and change in stock, or sales, closing stock and opening stock, then don't panic. You can easily calculate value of output from those details given. Okay, so this is the working of value added method. Now remember some important points about value added method. Number one, the value of intermediate goods should not be included. That is precisely the reason we take only value addition. See, again understand this, that what we are going to measure here cannot be 100% foolproof. No country can calculate 100% accurate GDP or 100% accurate national income. Not possible. Okay, it's always estimated. But while making that estimation, we try to ensure that we are avoiding as much duplication as possible. We don't want duplication. We don't want a same item being added in our GDP or NDP or national income again and again. Okay. So intermediate goods value should always be excluded. Then purchase and sale of second-hand goods should not be included. Okay, purchase and sale of second-hand goods. The transactions in second-hand goods are not a part of national income accounting. Why so? Because national income is a flow measure. Remember, GDP is a flow measure. So we always consider only the production of current year. Okay, so 5 years back, I purchased a car. I am selling it this year. So somebody purchased it and I am selling it. Can this transaction be added to GDP? No, it cannot be, because it's an old car. It's a second-hand car. It was counted in India's GDP in the year when it was produced. Now again, it has not to be added to the GDP. It will be double counting if we do so. Okay, so that should be avoided. However, the commission earned on account of sale and purchase of second-hand goods is included. Any commission, any brokerage, any income which is generated through the services provided to facilitate this second-hand goods transaction. That service, if it is provided and the income is generated because of that service, that will be a part of current year's national income. It is included, it is considered. Okay. Imputed value of self-consumed goods should be included. This we have already discussed, if you remember, when we are discussing production boundary, SNA, System of National Income Accounting, remember? So we have already discussed this there, that even the self-consumed goods by the farmers or people working in the forest department or people working in the fishery segment, whatever goods they are consuming for their own, they are also a part of India's GDP and national income. So self-consumed goods will be included, but self-consumed services should not be included. Why? Because services as it is are difficult to value, and self-consumed services are even more difficult to value. So it would not be objectively possible to find out a proper value of self-consumed services, and therefore self-consumed services are not a part of GDP. But yes, self-consumed goods can be valued because they would have a market price, so they can be valued and therefore their value is added to GDP. And lastly, own account production should be included. Own account production, that is production which is made for their own self. This is especially in reference to fixed assets. People sometimes build machinery for their own use, right? They build buildings for their own use. So that is own account production. They are producing for their own, and that is also included in GDP. Not necessarily that you have to produce it for selling, only then it will be a part of GDP. That's not the case. GDP would include even those goods which you are producing for your own. Okay, so these are some of the important points that you need to remember about value added method. Okay, one more time, value added method, how the calculations are made: economy divided into sectors, sectors into subsectors, subsectors into commodity groups or service groups. Each commodity group or service group would have producing enterprises. For each producing enterprise, calculate NVA. NVA is what? The value of output minus intermediate consumption minus the depreciation. You obtain NVA of producing enterprise, add NVA of all the producing enterprise to obtain NVA of commodity group, add the NVA of all commodity groups to obtain the NVA of subsector, add the NVA of all subsectors to obtain NVA of the sector, add NVA of all three sectors to find out NVA of the economy, which is nothing but NDP at market price. From this NDP at market price, we know how to find out NNP at factor cost. Right? Since NDP at market price, we want to find out NNP FC. So we add NFIA to NDP market price and we deduct indirect tax. We add back subsidies. That will give us NNP FC. Okay. So this was value added method. Guys, please read this, revise this, understand this thoroughly, okay? It's not something that you will be able to understand just in one time. It will require some practice, some revision. Only then you will be able to understand and remember this. Fine? And it's not just the theory portion that you are supposed to remember. You will have to use this practically as well. There are going to be numericals based on this. Okay? So be very thorough with whatever you are studying. Okay, but this is okay. Value added method completed. Now before I go to the next method, very quickly we are going to browse through your notes. See, measurement of national income. Now in India, national account statistics are compiled by National Accounts Division in the CSO. CSO is Central Statistical Organization, right? Ministry of Statistics and Program Implementation. CSO comes under this ministry. CSO is an organization. It comes under the Ministry of Statistics and Program Implementation. They publish annual as well as quarterly estimates of national income. Okay. This publication is the key source material for all macroeconomic data of the country as per the mandate of Fiscal Responsibility and Budget Management Act 2003, FRBMA. Fiscal Responsibility and Budget Management Act 2003. As per that particular act, the Ministry of Finance uses the GDP numbers at current prices to determine the fiscal targets. Fiscal targets are the targets set by the government for the economy. Okay, they are known as fiscal targets. So if government decides that, okay, from our GDP, this is what we are going to spend on education, this is what we are going to spend on defense. So that target is set based on the GDP of current price. Okay. The Ministry of Statistics and Program Implementation has released the new series of national accounts revising the base year from 2004-5 to 2011-12. This I have told you in the previous session that the base year that is currently being used is 2011-12. Earlier it was 2004-5. Okay. I think the one before that was 1995, 95-96. Okay. In the revision of National Account Statistics done by CSO in January 2015, it was decided that sector-wise estimates of GVA will now be given at basic prices instead of factor cost. So, since January 2015, the Ministry of Statistics and Program Implementation decided that they will give the gross value added number, GVA numbers, at basic prices instead of factor cost. Sir, what is the difference between basic prices and factor cost? Okay, we know the two terms, market prices and factor cost, right? We know those two terms, but we don't know what is basic price. So now I'm going to tell you what is basic price. Okay, for that you need to understand this. Remember that I told you indirect taxes and subsidies. These were the two main reasons of difference between market price and factor cost, correct? Now, indirect taxes are of two types: product taxes and taxes on production. Similarly, subsidies are also of two types: product subsidies and subsidies on production. Okay. Sir, what is the difference? I told you the difference. See, product taxes are the taxes which are levied on the product. It depends upon the volume of production. Higher the volume, more will be the tax. Lower the volume, less will be the tax. Okay, so that is product tax. What is taxes on production? Taxes on production is on the activity of producing goods. It's not on the it does not depend upon the quantity of production. Whether you produce 5 units or 50 units or 500 units, it's fine. Right? The tax amount will remain same. That is taxes on production. In the similar way, we can distinguish between product subsidies and subsidies on production. I have also given you some examples for your reference. See. First, I'll give this meaning and then I'll continue with my explanation on basic prices. Okay, don't worry. See, production taxes or production subsidies, they are paid or received with relation to production and are independent of the volume of actual production. They are independent of the volume of actual production. So it does not matter how much is the actual quantity produced. Okay, it depends on the activity of production, not the volume of production. Examples of production taxes: land revenues, stamps and registration fees, tax on profession, etc. Production subsidies, examples: subsidies to railways, input subsidies to farmers, subsidies to village and small industries, administrative subsidies to corporations and cooperatives, etc. None of these subsidies are in relation to the volume of production. So government does not say that, okay, you produce 500 units, we will give you this much subsidy. You produce 5,000 units, we will give you this much subsidy. No, that's not the case. Okay. The product taxes or subsidies are paid or received on per unit of product. Now we are talking about product taxes and subsidies, not production. The product taxes or subsidies are paid or received on per unit of product. Some examples of product taxes are excise, sales tax, service tax, GST, in fact, import and export duties, they are all covered here. Product subsidies include food, petroleum and fertilizer subsidies, interest subsidies given to farmers, households, etc. through banks. Okay, so this is the difference between product taxes, production taxes, and product subsidies, production subsidies. Sir, but why is this difference so relevant here? This difference is relevant because based on this difference, we are going to be distinguishing between the factor cost and basic price concept. Okay, now see very carefully, pay attention, okay? Basic price is the amount receivable by the producer, from the purchaser for a unit of product, minus any tax on the product. Tax on product, okay, not production tax. Tax on product minus tax on product plus subsidy on the product. Not production subsidy, subsidy on product, the one which depends on volume. Okay, clear? See, so your formula now becomes basic price. If you're trying to calculate basic price from market price, the one that is stated here, okay, amount receivable by the producer is nothing but market price. So market price minus product taxes plus product subsidies. The same thing that is written here as well, okay. The other way, you can also calculate it from factor cost. So basic price equals to factor cost plus taxes on production. Taxes on production minus subsidies on production. Okay. When you were distinguishing between market price and factor cost, this is the formula that you made. See, factor cost is equals to market price minus indirect tax plus subsidy. Correct? This was the formula. Now this indirect tax included both types of indirect tax, on production as well as on product. In the similar way, subsidies also included both types of subsidies. Subsidies on production as well as subsidies on product. Okay? But this is different. This is not factor cost market price distinguish. Now we are distinguishing between the types of indirect tax and the types of subsidies. And that is how the basic price concept is created. Okay, so from market price, you just remove the indirect taxes of product, indirect taxes on product, and you add the subsidies of product. Then what you get is basic price. So MP minus IT on product plus subsidies on product. Correct? That will give you basic price. Clear? Fine. So this is your basic price concept. Remember this well, okay? Important. Okay, next is circular flow of income. This we have already discussed in the presentation as well. So this is not new for you. The production of goods and services are then distributed as factor incomes, that is rent, wages, interest, profit, which is then either spent on consumption or investment expenditure, which again leads to production. So it's a cycle which will go on and on. The production phase, firms produce goods and services with the help of factor services. Income or distribution phase, the flow of factor incomes in the form of rent, wages, interest and profit goes from the firms to the household. The firms will pay, households will receive. And in the expenditure or disposition phase, the income received by different factors is spent on consumption goods and investment goods. The expenditure leads to further production and sustains the circular flow. So as I said, it's a cycle. These processes of production, distribution, disposition keep going on simultaneously, and therefore we can look national income from three different angles: from production flow, that is value added flow, income flow and expenditure flow. And corresponding to the three phases, there are three different methods: product method, income method and expenditure method. Correct? This is all we have discussed. And we started with this value added method. We have already covered this. So once again, very quickly, we are going to browse through the notes. Product method, also known as value added method, also known as industrial origin method or net output method. Right? Don't forget the names, okay? Now, value added method is the sum total of the net value added at factor cost across all producing units of the economy. We measure the contribution of each producing enterprise. Now you know the term producing enterprise, okay? I explained it to you. Producing enterprise in the domestic territory of the country in an accounting year, and it entails that is, it follows the consolidation, that is combining of production of each industry less intermediate purchases from all other industries. Correct? Okay. We can divide the entire process into steps. Step 1 was identifying the producing enterprise, classifying them into different sectors. So as we know, the producing enterprises are mainly classified in three sectors: primary, secondary, tertiary. These sectors further divided into subsectors, each subsector further divided into commodity groups or service group. So you remember the chain, correct? Then you estimate GVA, MP by each producing enterprise. How do you find out GVA MP? That is value of output minus intermediate consumption. I told you that value of output is nothing but sales plus change in stock. Correct? Then you find out NVA. How do you find out NVA? GVA minus depreciation. Simple. NVA of all producing units will give you NVA of subsector, and NVA of the subsector will give us NVA of the sector, and the NVA of entire economy is the NDP. Now since this is at market price, therefore NDP will also be at market price. And to calculate national income, we subtract indirect taxes and add NFIA from the NDP MP to get national income. Okay, so this you can also write as your formula here. I'll just note it down for you guys. NDP MP minus net indirect tax. Net indirect tax, that is minus indirect tax plus subsidy, correct? Plus NFIA. So this will be your formula. Okay. And what are the specific things which are included? Inclusions: own account production of fixed assets by government or enterprises or households. That is also a part of national income calculation. Production for self-consumption, that is also a part of national income. And imputed rent for owner-occupied houses is also a part of national income. Okay. What is imputed rent? You understand that? This is something that you learned in foundation, I think. Imputed rent is the assumed rent, notional rent. Right? It's not actual, because the owner has occupied the house himself. So obviously that house is not going to earn any rent. But since we understand that house, that premises does also have a potential of earning something. Therefore, we consider its notional rent or imputed rent, assumed rent you can say, in the national income. Okay, so that is to be added. Fine, this was value added method, the first method out of the three completed. So now the next method that we are going to cover is income method. As we know, there are three methods through which we can measure national income. The first method that we discussed was value added method. Now the second method coming for the discussion is income method. Now we already know that whatever goods and services are produced, they are distributed among the factors of production based on their contribution in that production activity. So land, labor, capital and entrepreneur have contributed something to the production process, and depending upon their contribution they get a part of that production as their income. Now that is known as rent, wages, interest and profit. Okay. Now before we go into the discussion of income method, I just want to give you a fair overview of this method, that how exactly this method helps us to measure national income. Okay. Under this method, incomes are divided into three categories. Okay. One is what we are going to call labor income. The other one is what we will call non-labor income. And the third one is mixed income. Okay, labor income, non-labor income and mixed income. Now what do we mean by it? See, when I say incomes, we know that incomes earned can only be of four types: rent, wages, interest, profit. Correct. Now out of rent, wages, interest and profit, which one do you think will be labor income? Which of these would be labor income? Obviously sir, it will be wages. So labor income is wages. The balance, that is rent, interest and profit, RIP, will be non-labor income. Okay, not rest in peace. Okay, rent, interest and profit. Okay, they will be non-labor income. Now sir, what about salaries? Salaries is also wages, that is also labor income. See, whatever name you give it, anything which is received from employer to the employee, received by employee from the employer in return of the services that he has provided, in return of the work that he has done, in return of his contribution to production, right? That is known as labor income. Now you call it wages or salaries or bonus or commission or any compensation which is received by the employee in kind. You know what is compensation in kind, right? For example, the employer gives rent-free accommodation to the employee. Employer gives the company's car to the employee for using. Right? Employer pays the mobile bills of the employee. These are all compensations in kind. They are also part of labor income. Similarly, the employer's contribution to PF. This is all written in the notes, don't worry. I'm just giving you some examples so that you can understand. So, employer's contribution to Provident Fund, PF, that is also labor income. Okay? Anything which is given by employer to the employee in return of the contribution that employee has made in the production, that is known as labor income. The balance all incomes are non-labor income. So rent, interest, profit, they are all non-labor income. Royalty is also non-labor income. Okay, sir, what is profit earned by government enterprise? Profit in a non-labor income. Simple. Okay, so anything which is not a receipt by an employee from the employer in return of the contribution that he has made to the production is non-labor income. Simple as that. Okay. And sir, what about pension? Pension is also received by employee from the employer, right? If a government employee after retirement receives pension, then that is also a labor income, correct? No, that cannot be labor income. It's a transfer income. It's a transfer income, Ray. It cannot be a part of national income. Pension is not received against any contribution made in the production of goods and services. How can pension be a part of national income? Even while discussing value-added method, we were very clear. Even when we were discussing GDP, we were very clear that no transfer payments or transfer incomes can be a part of GDP. When you look at it from the point of view of payer, it is a transfer payment. When you look at it from the point of view of the receiver, it is transfer income. It's the same thing. The one who pays, it's a transfer payment. The one who receives it, for him it's a transfer income. Okay, so transfer incomes or transfer payments are not a part of national income, and therefore pension is not to be considered as income while calculating national income. Clear? Okay. So what is this mixed income then? See, sometimes it becomes very difficult for one to classify that what part of the income received by them is labor income and what part is non-labor income. Even among non-labor income, what is capital, how much is the income due to capital, how much is the income due to labor that we have undertaken, or how much is the income due to the entrepreneurial abilities that we have used. It's difficult to dissect it, bifurcate it, and therefore it cannot be classified under one particular head. You can neither say it's rent nor interest nor wages nor profit. Then how do you distinguish that? How do you consider that income? Such an income is known as mixed income. Okay, for example, let's say I start my own coaching classes. Okay, I start my own coaching institute. Now in my own coaching institute, I have invested money. Okay, I have also taken the risk of undertaking the business on my own. I'm not working for somebody else. I'm undertaking the business on my own accord, right? I'm also teaching there. So I have undertaken some labor activity as well, right? Now, at the end of the year, for example, if I get 10 lakh rupees, what do I say? Whether the 10 lakh is entirely profit from economic point of view. Accounting point of view, it is profit. We know that. From economic point of view, I cannot consider that entire 10 lakh rupees as profit. Because it's not only because of my risk-taking abilities that I have earned that money. I have also taught there. I have also given lectures. So it's also some labor component has also been used to earn that 10 lakh. Correct? I have also invested my money. So some capital investment has also been there. Right? So some part of that 10 lakh is due to labor undertaken, some part of it is because of the capital investment, some part of it is because of the entrepreneurial risk taking. How do I distinguish how much is rent, how much is wages, and how much is interest? Correct? We cannot be distinguishing that, and therefore such an income is known as mixed income. So under income method, all the incomes are either treated as labor income or non-labor income or mixed income. Right? And whether labor income or non-labor income or mixed income, of all the residents of the country, listen to me very carefully, all the residents of the country, when you add these three incomes for all the residents of the country, what you will get is NDP at factor cost. NDP at factor cost. Okay, sir, why NDP and why factor cost? Okay, I'll tell you. See, net, because I have not included depreciation. I'm adding rent, wages, interest, profit. There's no depreciation component here which is being added. So it's not gross, it's net. It's domestic. Okay, it's domestic because within the domestic territory, if I am taking the incomes earned within the domestic territory of residents as well as non-residents, non-residents. If I am taking the incomes earned only of residents, whether from India, whether from abroad, okay, only residents, though I can directly find out NNPFC. But if I am taking the incomes earned by the residents as well as non-residents within the domestic territory, then it will give me net domestic product at factor cost. Why factor cost? Because I am adding rent, wages, interest, profit. Right? And to this, you add NFIA to get your national income. Okay? This was just an overall understanding of it. Okay? We are going to cover this systematically, properly, step by step. But before I took you there, I wanted you to know the overall structure of income method. So now let's see what income method has in store for us. Okay. So as we know, whatever is produced by the producing units is distributed among the factors as incomes. Correct? Whatever the producing units produce, they distribute the same to the factors of production as their incomes. The national income is measured by adding the factor incomes paid to the 4 factors of production. What are we adding? The factor incomes. Factor incomes being rent, wages, interest, profit. Okay? And this method is also known as the factor payment method or distributed share method. The factor payment method or distributed share method. Okay? How does it work? See the income components that we just discussed. The incomes are divided in 3 parts. Which 3 parts? Labor income, non-labor income and mixed income. See, labor income, non-labor income are like generic names. Okay, these are just used to help you understand. The proper name, the technical names which are given to them are: labor income is known as compensation of employees. Okay, labor income is known as compensation of employees. Non-labor income is known as operating surplus. These are the names that you will find in your notes as well as study material that you are going through. Okay, so labor income is nothing but compensation of employees. Non-labor income, that is rent, interest and profit, RIP, that is nothing but operating surplus. Okay, mixed income is known as mixed income anyways. There is no other name for it. Okay, see. The first one, 3 parts, right? The first one is compensation to employees. Okay, so compensation to employees or income earned as labor income includes wages, salary, commission, bonus, employer's contribution to PF and any compensation made in kind. Okay, whether you call it wages or salaries or bonus or commission or any compensation even that is made in kind, or even employer's contribution to provident fund, what employer deposits in the employee's contribution, employee's PF account, right? All that is covered as labor income or compensation to employees. But very specifically mentioned that it excludes pension. Dear people, please remember that pension cannot be a part of national income. It's a transfer income rate. It cannot be a part of national income. Okay? Chalo. Next, operating surplus. Operating surplus is nothing but non-labor income, RIP. Okay, sir, what RIP? There are so many things which are written here. We are going to RIP if we have to read and remember all this. Array, it's nothing. It's just the 3 things. RIP. See, I'll tell you. Rent. Okay. Interest. Correct. Royalty is a kind of rent. Royalty is a kind of rent. Okay, but specifically mentioned so that there is no confusion. But it's still considered as rent. Okay. Dividend. Dividend is out of the profit earned. So profit I can say. Okay. Undistributed profit of corporation. So now understand, whatever profits the company has earned, whether they have been distributed as dividend or they are undistributed, they are still going to be considered as a part of non-labor income. So profit which is distributed as dividend and profit which is not distributed, undistributed profit, they are both part of non-labor income. Okay, so again profit. Then profit of unincorporated enterprise. Unincorporated enterprise means those enterprises which are not companies, firms. Okay, those which are not companies, even they can earn profits, right? Profit is not sole prerogative of only companies. Even small businesses can make profits, even those which are not companies. So that profit again is covered here, and profits of government enterprise, that is also profit. So what did I tell you? RIP, rent, interest, profit. Rent, which includes royalty as well, interest, profit. Now profit could be either the profit of corporates, or it could be the profit of government enterprise, or it could be the profit of unincorporated enterprises. It could either be the undistributed profit or it could either be the dividends. Anyways, profit is going to be a part of non-labor income. Okay. And last but not the least, mixed income of self-employed. They say it's mixed income of self-employed. What do you mean by self-employed? People like us, right? For example, when you become CA, you will be starting, for example, your own practice. So you will be self-employed. If you're practicing CA, then you are a self-employed. If you're working somewhere, if you're an employee, of course, whatever you will earn will be a part of labor income. But if you have started your own practice, like a doctor, a lawyer, right? They also start their own practice. A CA, a CS can start their own practice. Now, in such a case, what will happen is that it will not be, possible for us to distinguish at the end of the year. Okay, that for example, I have earned net of expenses. I have earned, for example, 8 lakh rupees. Now, this 8 lakh rupees is my profit. Though from accounting point of view, you say it's your profit, but that's not the case from economic point of view, right? Profit is something that you get in return of the risk taking factor. If you have taken a risk and because of that you're earning something, that's profit. But since it's your own practice, so you also work. You work day in and day out, right? You have meetings with clients, you check their files, you prepare the documentation, you file the returns. So you as an individual, you perform labor activity. That is also one of the contributors in earning that 8 lakh rupees. So economic point of view, we cannot say that whatever we have earned out of that practice is solely because of risk taking. Some labor component is also there. Some capital component might also be there. Correct? And therefore, that 8 lakh rupees cannot be solely considered into any one of the categories. Hence, it's called mixed income. So usually self-employed people have mixed income. So sir, only self-employed people have mixed income. Is that the case? Well, no. Even businesses, small businesses can have mixed income, right? See, some examples have been given to us. See. So, mixed income is mostly found in economies where subsistence production, I love the word, subsistence production. What is subsistence production? Production which is undertaken at small scale, enough to, lead a decent life. That kind of a production activity is known as activity undertaken at subsistence level. Not like Tatas and Ambanis and Birlas. Not so large scale. Normal, reasonable scale, okay, where we, meet our expenses and live a comfortable life. That kind of a production activity is known as a production undertaken at subsistence level, right? So any economies where subsistence level production and small commodity production is dominant, right? So many of people in that economy are undertaking subsistence level production, or they are into small commodity production, then it's quite likely that their income will be a mixed income. If you take the example of a guy running a provision store somewhere near around your house, so what do you observe? That particular individual has invested money in that shop. Okay, he bought the shop, for example. So he has invested money there. Acha, he's also working there. Correct? He's also taking the risk. Right? So whatever he earns, it's not just because he has taken a risk or not just because he's working there. There are several contributions made on his behalf as a capitalist, as an entrepreneur, as a laborer, and from that he is earning that money. So his money, whatever income he has generated, is known as mixed income. This is also observed in agriculture, trade and transport. Agriculture sector, in trade, transport, also these are normally seen that the income which is earned by the people is a mixed income. For example, let's say a transport guy, he owns his own truck, okay, and he on contractual basis he delivers goods from location A to location B. Now he gets some money against it. Now that money, is it solely because he has worked as a driver? Is it only because he has worked as a driver? No. He also had a truck, so he had made investment there. Right? Instead of working with somebody else, working as an employee, he took a risk and he wanted to run his own truck. Correct? And therefore, we say he is also a risk taker, he is also an entrepreneur. So again, whatever he has earned is mixed income. Clear? I hope you guys are awake and listening, huh? This is very important from understanding the point, understanding the method. Okay, you understand the method well and you will be able to crack the numericals. See, the answers most of the times are in the explanation itself. But the problem is that we don't pay attention in explanation, right? We find explanation so boring, we usually doze off. Don't do that. Stay awake. Okay. Now we can understand the working of income method. So we add the rent, wages, interest and profit paid out by all producing units in the domestic territory. See, domestic territory, huh? Check the words. Domestic territory. Okay. What are we doing? We are adding the rent, wages, interest, profit paid out by the producers in the domestic territory of the country, whether it is paid to residents or non-residents, doesn't matter. We are only taking into account what? That the payments have been made by the units working in domestic territory. Whether they have made the payment to residents or they have made the payments to non-residents, that is none of our concern. Okay, so this will give us net domestic product at factor cost, NDPFC. From that NDPFC, we will have to find out an NPFC by adding NFIA. This NDPFC is nothing but compensation of employees plus operating surplus plus mixed income. Okay, and when you add NFIA to it, you get national income. Okay, and we don't need to add NFIA. If incomes received by the resident units of the country are added directly instead of adding the incomes paid by the producing units. So instead of adding whatever has been paid as rent, wages, interest, profit, if you add whatever has been received as rent, wages, interest, profit by the residents of the country, you don't have to add anything. It's already an NPFC. Correct? Whatever rent, wages, interest, profit the residents of the country have earned during the year. If you add that, it's directly an NPFC now. You don't further need to add NFIA to it. Okay. Sleepyheads, is this clear? Now, some things to be remembered here in the income method as well. Income from illegal activities like smuggling, theft, gambling should not be included. This is something that we covered when we were discussing GDP. Remember? We consider only the goods, not the bads. Okay, so on those lines, when you are measuring national income through income method, you are not supposed to consider the income which is earned through illegal activities, because smuggling, theft, gambling, etc. these are not the production of goods, it's the production of bads. Okay, any income which is corresponding to the production for self-consumption. Self-consumption we know, right? We have discussed this in the valued method. So any income which is corresponding to the production of self-consumption, that income is also to be taken into account. Brokerage or sale, on the sale or purchase of shares and bonds is to be included. However, shares and bonds being sold, that is not included. That income is not included. For example, if I sold some shares in stock market, if I sold some shares and I earned some money from it, that is not a part of national income. Okay, because it's not the income which is generated against the production of any goods or service, right? But if somebody earns a brokerage from that transaction or any commission from that transaction, that is fine. We can add that to national income. Okay. Income in terms of windfall gains should not be included. What are windfall gains, guys? Windfall gains are unexpected gains like lottery. Okay, they should not be considered. Okay, because we have not received that against the production of any goods or services. So we should not be including that in counting national income. Sir, will it be included in personal income? Definitely yes. Personal income, it will be included. National income, it will not be included. Okay, and lastly, the transfer earnings like old age pensions, unemployment allowances, scholarships, pocket expenses, etc. should not be included. Okay, these are all transfer earnings. No production has been undertaken in order to receive these incomes. When your parents, your father gives you pocket money, it's not against the provision of any services, right? The poor fellow, even if he asks for a glass of water after returning home from a full day's work, you are not going to even offer that to him. So pocket money that you are receiving is not against any services. Oh, if somebody says, sir, we are very obedient, we give him the glass of water if he asks to ask us, then is it still transfer earning? Yes, it's transfer earning. Okay, I just on a lighter note I said that, but doesn't make a difference whether you give him the glass of water. If you don't give him the glass of water, whatever pocket money is giving you is still transfer earnings. Okay, unless of course your father has, you know, some business and you join that business as an employee and you are getting paid salary, then it's what you are earning as labor income. Otherwise it's transfer earning. The pocket expenses given is transfer earning. Okay, so doesn't matter whether you give glass of water or not, but you should. Okay, so this was a discussion on income method. A quick highlight of the method if I can give you. See, the incomes are broadly classified as compensation to employees, which is labor income, non-labor income, which is rent, interest and profit, RIP. When I say rent, interest, profit, rent also includes royalty, and profit includes the profit of unincorporated enterprises, profit of government enterprises, dividends, as well as the undistributed profits of the corporates. Okay, so this is labor income, non-labor income. Then comes mixed income. Mixed income is the income which cannot be entirely classified under one head. Then we consider it as a mixed income. And for calculating NDPFC, NDP, domestic, NDPFC, we add up the rent, wages, interest, profit paid out by all producing enterprises working within the domestic territory of the country. Whether it is paid to residents or it is paid to non-residents doesn't make any difference. This is going to give us NDPFC. From that NDPFC, we can find out NNPFC by adding NFIA, net factor income from abroad. Okay. Instead of adding the factor incomes paid out by the producing enterprises, if you add up the factor incomes received by the residents of the country as rent, interest, profit and wages, then that will directly give us an NPFC. No need to add NFIA there. Okay. A very beautiful thing about income method that you should remember is that remember under production method, valued method, what was the variable that we were obtaining when you add the value added of all sectors and you find out the value added of the entire economy? What was the variable that was being calculated there? What was the first variable that you received, that you measured? It was NDP at market price. Right? It could have been GDP at market price as well if you would have calculated GVA instead of NVA. Okay. So under valued method or product method, you either find out GDPMP or NDPMP first of all. By adding the value added of all sectors, what you get is either GDPMP or NDPMP. But when you are measuring the national income with income method, you directly get NDPFC, factor cost. In valued method, you would first obtain the values at market price. Then you will have to convert it to factor cost to find out national income. But here in income method, you directly get factor cost value. Why? Because you are adding the components of factor cost now, rent, wages, interest and profit. Okay. So that is very important. See, these tricks are important when you solve numericals. You might not understand the importance of these tricks and these small distinguishes when we are going through the theory segment. But when we'll come to numericals, you would know that, okay, you should remember these tiny concepts. That is what will make your numerical solving smooth. Okay. So this was your income method. Now we are going to discuss it from your notes as well. Very quickly we are going to glance through your notes for income method. Okay, in your notes now, let's quickly mark the points that we have covered. Income method. We know that production is carried out by the combined efforts of all factors of production. The factors are paid factor incomes for their services. And in other words, we can say whatever is produced by producing unit is distributed among the factors for their services. Correct? So under factor income method, which is also known as factor payment method, also known as distributed share method, the national income is calculated by summation of factor incomes paid out by all producing units within the domestic territory of the country as wages and salaries, rent, interest and profit. See, this is the opening line when you are writing how do we calculate national income with income method. This is what you will always have to write: summation of factor incomes paid out by all producing units within the domestic territory as wages and salaries, rent and interest and profit. Okay, by definition it includes factor payments to both residents and non-residents. Okay. What other things should we consider, sir? See, only incomes earned by the owners of primary factors of production are included in national income. Primary factors are land, labor, capital, entrepreneur. Any factor which is obtained through these factors is not a primary factor. Okay. For example, I can say that electricity is not a primary factor of production because electricity is obtained through one of these factors or some of these factors. It's not a primary factor. So only income which is earned by the primary factor should be taken into consideration. Transfer incomes are excluded, of course. So wages included, but pension excluded. Correct? Labor income includes what? Wages, salaries, bonus, commission, employer's contribution to PF, compensation in kind. This is all considered as labor income, or we can say compensation to employees. Okay. Non-labor income includes dividends, undistributed profits, before taxes, interest, rent, royalties, profit of unincorporated enterprises, and government enterprises. We already have discussed this, RIP. So normally it is difficult to separate labor income from capital income because in many instances people provide both labor and capital services. Following are some examples. Self-employed people like lawyers, engineers, traders, proprietors, etc. In economies where subsistence production and small commodity production is dominant, there most of the income earned is mixed income, right? And in sectors such as agriculture, trade and transport in underdeveloped countries, including India, it is difficult to differentiate between the labor and capital element. And in order to overcome this difficulty, new category of incomes called mixed income is introduced, which includes all those incomes which are difficult to separate. All those incomes which you cannot segregate, which you cannot classify in different heads, they are all put into as mixed income. So NDBFCE is compensation of employees plus operating surplus, that is RIP, and mixed income of self-employed. Okay, and to this we add an FIA to obtain national income. Okay, so this is your discussion of income method. So guys, the next method that we are taking up is expenditure method. Now in expenditure method, we are going to try and find out the national income by adding up the expenditure made on final goods and services during an accounting year. Okay? See, here in expenditure method, the national income is calculated by summing up the expenditures on the purchases of final goods and services produced during an accounting year. Okay, and this method is also known as income disposal method. Okay, income disposal. So what you spend determines the national income of the country. Now guys, from numericals point of view, this method is super important. So please pay very good attention here. No sleeping, okay? Not like you are allowed to sleep in any other topic, but not in this one especially. Okay, don't even doze off. Okay, now what are the components of expenditure? First of all, we are going to discuss the components of expenditure. Please pay attention, okay? This is going to be technical. This is going to be hard on your heads. So please very patiently take deep breaths and listen to the discussion here. Okay. So expenditure can broadly be divided in three parts. Okay, as per this method, expenditure is classified in three parts. First is final consumption expenditure. The second is gross domestic capital formation. And the third one is net exports. Okay, final consumption expenditure, gross domestic capital formation, which we are now going to refer as GDCF, right, and net exports. The final consumption expenditure is further divided in two parts. One is private final consumption expenditure and the other is government final consumption expenditure. So PFCE and GFCE. Okay, let's discuss each one of them in detail. Starting with private final consumption expenditure. Okay, pay attention. Now, it's consumption expenditure. That clearly means that we are talking about the money spent on goods and services. Okay, we are talking about final consumption expenditure. That means we are talking about the money spent on consumption of final goods and services, not intermediate. Okay, and we are talking about private final consumption expenditure. That means we are talking about the money spent on final goods and services by the households, individuals, families, etc. Okay, this is just the simpler understanding of it. Okay, now going into the technical parts. So following expenditures are included in PFCE, private final consumption expenditure. See, the volume of final sales of goods, final sales, that means the sales made to final users, not meant for intermediate use. Okay, the volume of final sales of goods and services to consumer households. Okay, final sales of goods and services to consumer households and to non-profit institutions serving households. Sir Bouncer, what do we mean by non-profit institutions serving households? Okay, so whenever we talk about private final consumption expenditure, we definitely add the consumption expenditure which is incurred by a household. For example, let's say you go to a stationery shop and you purchase a full-scape book for yourself. Okay, the worth of that, the value of price of that full-scape book is, let us say, 30 rupees. So that means that 30 rupees will now be added to the national income because you have spent 30 rupees on that final goods, which is meant for your own consumption. It's not an intermediate good. Okay, it's meant for your consumption. Okay, now it might be the case that sometimes children living in slums, now they cannot afford books. So there are some charitable institutions, non-profit institutions, okay, NGO types. They purchase the books from the market, from the stationery, and they distribute these books to the children living in slums. Now the question is, sir, here the books purchased by those non-profit institutions, will that be considered when we are counting PFCE? Yes, it will be, because those non-profit institutions are purchasing those books on behalf of the households. Okay, they are not purchasing it with the intention of selling it. See, if they were buying it for reselling, if for example, retailer was buying from the wholesaler, then it will not be considered here. It's not PFCE. Okay, because he's purchasing it with the intention of reselling it, right? But the non-profit institutions are buying those books with the intention of distributing them to the children who are not able to afford it, and that's free of cost. They are not even going to charge any money from them, so it's not meant for reselling. Clear? Okay, so read this sentence. I told you it's technical, so pay attention. The volume of final sales of goods and services to consumer households and non-profit institutions serving households, right? So final sales of goods and services. What kind of goods and services? The goods and services acquired for consumption and not for use in production. Okay, the goods and services which are required for consumption, not for use in production. If they are bought for use in production, it is a part of intermediate consumption. We are not going to add the expenditure on intermediate goods. We are going to add only the expenditure made on final goods. Fine. So that is multiplied, volume, right? Volume, that means quantity. That is multiplied by the market price, and then summation is done. Okay. Next, the value of primary products. What are primary products? Which are produced for own consumption, like wheat, Okay, a farmer grows wheat, rice, fruits, vegetables and keeps a part of it for his own consumption. That is covered here. It will be considered as a part of private final consumption expenditure. Okay, a fisherman, correct? He is catching some fish and is keeping a part of it for his own family. That is also private final consumption expenditure. Okay, which are produced for own consumption by the households. That is also included. Okay, this is a list of inclusions. Payments for domestic services. Domestic services which one household renders to another. One household renders to another. For example, maids. Okay, if maids come to our houses for example washing clothes or washing utensils or cleaning the house, right? Then that is one household rendering services to another household. Okay, so any expenditure which is made on that is also included in PFC. Okay. The net expenditure on foreign financial assets. What are foreign financial assets? What are financial assets? Shares, debentures, bonds. These are all financial assets. Okay. So foreign financial assets. The net expenditure made on these. Net expenditure means the expenditure which our people incurred on foreign financial assets minus the expenditure which foreigners incurred on our financial assets. Okay, that is called net expenditure on foreign financial assets, also known as net foreign investment. That is one and the same thing. Now, this is also a part of PFCE. Okay. Now, this point very important to remember. Land and residential buildings purchased or constructed by households are not a part of PFCE. They are not a part of PFCE, guys. They are included in GDCF. Please do not include them here in PFCE. They are a part of GDCF. They are considered separately in GDCF. They are expenditures. We are considering them in expenditure method, but it will be considered under GDCF, not here. Okay. So, only expenditure on final goods and services produced in the period for which national income is to be measured, and net foreign investments are included in expenditure method of calculating national income. So that is all you include when you are adding PFCE. Expenditure made on the final goods and services produced in current year and the net foreign investments made in the current year. That's it. Okay. Sir, what about GFCE? Let's see what about GFCE. See, government final consumption expenditure is very important because there are certain things which only GFCE can help us cover under expenditure method to find out national income. When you try to estimate this using other methods, it will become more complicated. How so? See, the collective services provided by the governments, such as defense, education, healthcare, etc., they are not sold in the market. The services of defense that government provides, it's a collective service. It's meant for the entire nation. It's not sold in the market, right? Okay, the free education that government provides, it's not sold in the market. Correct? So it does not have a market price. So the only way they can be valued in money terms is by adding up the money spent by the government in the production of these services. So the only way for us to add these, to find out its monetary value, what we can do is we can add the expenditure which the government has incurred on providing such services. Okay. This total expenditure is treated as consumption expenditure of the government. Government expenditure on pensions, scholarships, unemployment allowance should be excluded. Now I think everybody should know why. Because these are transfer payments. Transfer payments are not a part of national income calculation. Okay, I think we are very clear on that part. Right? So this was PFCE and GFCE, which was a part of FCE, Final Consumption Expenditure. Right? Next comes GDCF, Gross Domestic Capital Formation. GDCF. Now, what does GDCF include? Let's see. It includes the following expenditure. The final expenditure on machinery and equipment and own account production of machinery and equipments. So if we have purchased machinery from outside, then also it is considered. If we have developed a machinery for ourselves, own account production, then also it is considered. Expenditure on construction. See, expenditure on construction was not considered in PFCE. It was specifically written there. Remember that expenditure on construction of residential buildings is not included in PFCE, or purchase of land is not included in PFCE. That is included here in GDCF. Then expenditure on changes in inventories. Changes in inventories bolega to value of closing stock minus value of opening stock. Okay, changes in inventory means value of opening stock minus value of closing stock. And lastly, the expenditure on acquisition of valuables such as jewelry and works of art. That is also considered as GDCF. Clear? Pay attention. See, these things, when they will be asking in numericals and it doesn't click, it's going to be very difficult for you. Okay? The third component of expenditure under expenditure method was net exports. Net exports means exports minus imports. Sir, why is this considered as an expenditure? Exports is an income, right? Correct. But expenditure method views it in a different perspective. Expenditure method says that exports, listen to me, exports, India's exports are the expenditure made by foreigners on goods produced in India. What is exports? The expenditure made by foreigners on goods produced in India. What are imports? Imports are expenditure made by Indians on goods produced in other countries. So the difference of these two expenditures is net export. Export minus import. Could be positive, could be negative. Okay? So exports are expenditure made by foreigners on goods and services produced in the country. Imports, the other way around, expenditure made by a country on goods and services produced in other countries. Net exports is the difference between exports and imports. It can be positive or negative. Okay, easy enough? Sir, we understood the components of expenditure. Now, how do you find out national income using this method? I'll tell you. We'll be able to find out GDP at market price by adding the components of expenditure. So how do you find out GDP at market price using this method? GDP at market price is consumption expenditure C plus investment expenditure I, that is your GDCF. Okay, investment expenditure is GDCF, plus government expenditure G, and net exports, that is NX. So we can say that GDP MP by this method is C plus I plus G plus X minus M. Okay, or NX. Both are fine. From GDP MP, we know how to find out NNPFC. This is the formula. GDP MP minus depreciation because I am finding out net from gross, so I have to deduct depreciation, plus NFIA because I am trying to find out national from domestic, so plus NFIA, and minus net indirect taxes because I am trying to find out a factor cost value from market price. So minus net indirect taxes, or you can say minus indirect tax plus subsidy, one and the same thing. Okay, see, remember people, in value-added method, what we calculated first by adding the value-added of all subsectors and all sectors was either GDP-MP or NDP-MP. The value would be at market price. Under which method? Value-added method. Under income method, the value will be at factor cost. It will be NDP-FC if you add up the rent, wages, interest and profit paid out by all the producing units in the domestic territory of the country during an accounting year. Okay, so it will be at factor cost. Again, in expenditure method, it will be at market price because you are adding the expenditure made on final goods and services produced in current year at market price. Expenditure would obviously be made at market price, right? Correct? When you buy something, it's obviously at market price. Fine. So remember that is going to be very useful. Value-added method gives you MP. Income method gives you FC. And expenditure method again gives you MP. Okay? Chalo. Next. So this is working of expenditure method. Now question arises, is the national income same by all three methods? We have now completed the discussion of all three methods. So we now have to wonder, is the national income calculated by all three methods same? Theoretically, yes. Yes, because you are trying to look at the same thing from three different dimensions, right? National income is the same. You are just trying to understand it from three different dimensions, three different angles, from the production side, from the income side, and from the expenditure side, right? So it should be same theoretically. Practically not so. Because practically, see, there are many difficulties. It's not possible to obtain data, accurate data for all three methods, and sometimes it may be the case that without data you cannot find the national income by each of the three methods. Even if you find, the answers may not tally. So practically problems may arise, but theoretically, logically, they should be same. Okay. So ideally, all the three methods of national income computation should arrive at the same figure. Should arrive at the same figure, not will arrive at the same figure, okay? So when national income of a country is measured separately using these methods, we get a 3D view of the economy, three-dimensional view. Each method of measuring GDP is subject to measurement errors, and each method provides a check on the accuracy of other methods. By calculating total output in several different ways and then trying to resolve the difference, we will be able to arrive at a more accurate measure than would be possible with one method alone. So what you should be doing is calculate the national income by all the methods, then try to resolve the difference. That will give you a more accurate national income value rather than by just finding out national income with one method alone. Okay? Fine. So that answers this question, that is the national income, same by all three methods. One more question that we have to think about, which method is best? Income or expenditure or value-added, which is best? See, there is no one answer to that question. The answer depends from countries to country individually. Okay, it's a subjective thing. Not one method is suitable for all countries. Usually it's said that for a developed country, income method is fine because in a developed country, the income will be more or less correctly disclosed. Majorly, the people will be disclosing their incomes correctly. The chances of tax evasion will be quite less there, and therefore using income method you would be able to derive at quite an accurate figure of national income. But in a developed country, in a developing country like ours, where incomes are always, a secret. Not even income tax department should know how much I earn. In fact, they are the ones who should never know how much I earn, correct? That's the strategy which most of the people adopt. In that case, it becomes difficult to find out national income using income method. It will be highly underrated even if we use the method in our country. The country would seem more poor than it actually is. So it's not usable, it's not suitable for the developing countries like India. Okay. So see, the same thing has been stated here, that income method is more suitable for developed economies where people properly file the returns. Nowadays, the expenditure method is gaining into trend. See, with the growing facility in the use of the commodity flow method of estimating expenditure, an increasing proportion of national income is being estimated by expenditure method. So people try to understand the commodity flow, that how much of goods and services are being consumed, and from that they try to understand the national income. So expenditure method is gaining huge importance these days. As a matter of fact, countries like India are unable to estimate their national income wholly by one method. We do not, and this is the truth, okay, we do not measure national income by just one method. It's not possible for us. So in agriculture sector, NVA is estimated by production method. In small scale sector, NVA is estimated by income method. And in construction sector, NVA is estimated by expenditure method. So in different sectors of the economy, we use different methods to find out national income. Okay. So this was the discussion on expenditure method. Now very quickly we are going to go through your notes for the same expenditure method. I'll just quickly highlight and mark the important things here so that you are comfortable when you are reading. In expenditure approach, which is also known as income disposal approach, the aggregate final expenditure in an economy during an accounting year is added. For measuring GDP, we add the value of the goods and services purchased by each type of final user, that is household, businesses and government. The total expenditure is classified as follows. The first is final consumption expenditure, second is gross domestic capital formation, GDCF, and the third one is net exports. The first one has two parts, private final consumption expenditure and government final consumption expenditure. Okay, so PFCE, the volume of final sales of goods and services to consumer households. Okay, consumer households and non-profit institutions serving households. Okay, that is acquired and consumption, acquired for consumption, not for use in production, are multiplied by market price and then summation is done. It's the same whatever we have studied there. It also includes the value of primary goods which are produced for own consumption by households, payment for domestic services which one household renders to another, net expenditure on foreign financial assets or net foreign investment. Land and residential building purchased or constructed, not a part of PFCE, they are GDCF. Okay, talking about government final consumption expenditure, the expenditure that the government makes on collective services like defense, education, healthcare, etc. They are not even sold in the market. So the only way we can find out their money value is by adding the expenditure which the government has incurred on these services. The total expenditure is treated as consumption expenditure of government, and the transfer payments that the government makes does not form a part of this calculation. Okay, then comes GDCF. includes final expenditure on machinery and equipment and own account production of machinery and equipment, expenditure on construction, expenditure on changes in inventory, expenditure on acquisition of valuables such as jewelry and works of art. NDCF can be calculated by deducting depreciation from GDCF. This is important, okay? Remember that if you want to find out NDCF, you just deduct depreciation from GDCF. Now, in your calculation, whenever you are solving a numerical, you have to pay attention to the fact whether you have been given GDCF or NDCF. See guys, if GDCF is given, you will be able to find out GDP. You add final consumption expenditure, okay, PFCE as well as GFC both, plus GDCF, plus net exports. Since you are adding GDCF, it will give you GDP at market price. But instead of GDCF, if the question has given you NDCF, so you add this final consumption expenditure, NDCF and net exports, you will get net domestic product. Understand the trick? Very, very closely, okay? Pay attention. So I have also given a note here for that. This is the note which I have given here for you guys. See, the sum of final consumption expenditure, GDCF and net exports is GDP at market price. From GDP market price, you can easily find out NNPFC. You know the formula now, it's not new to you, okay? The important note here is that instead of GDCF, if NDCF is added to consumption expenditure and net exports, the resulting value will be NDP at market price, not GDP at market price, because depreciation component has already been taken out. So what you obtain by adding final consumption expenditure and NDCF and net exports, that is going to be your NDP market price, not GDP. Please remember this, okay? Please remember this. Net exports we already know can be positive or negative. It's the difference between exports and imports. Okay. Will national income be same by all the methods? Ideally yes, practically no. Okay. So we try to measure national income in 3 different ways, and then we try to resolve the difference so that we can arrive at a more accurate measure of national income. And which is the more appropriate method? There is nothing like the most appropriate. It depends from country to country. As I told you, income method is more relevant in developed economies, and right now, these days, the most commonly used method is the expenditure method. And India, if we are talking about specifically India, we don't use any single method. We use all the methods. Some sectors of the economy use value-added method, some sector use the income method, and some other sectors use the expenditure method. And then by combining all of them, we finally arrive at one national income figure. Okay, so that is how things are done in India. Right guys, so I am concluding this session here. We are still left with a small portion of this chapter, this unit. We are yet to cover something known as regional system of accounts, and we are also required to cover limitations of national income, and then after we are going to be taking up some numericals. Okay, so for that, stay tuned. We'll be meeting in the next session where we'll be covering up these aspects of the first unit. Till then, take care, stay safe. Bye guys.